Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I am the tax director here at Kress Cooper. Today I've been joined by my colleague Mahar Afzal, who is the managing partner, and together we will take you through today's presentation. So since the last 4 weeks, we have been discussing the corporate tax group guide, which FTA had introduced in January. It is a very detailed guide, and we have been discussing various sections of the guide. So if you've missed any of our lectures of the previous lectures of this guide or any other lectures or any other topic that we have been discussing every Wednesday, so you can always go to our YouTube channel. And if you have any questions regarding these webinars, feel free to email us at info@kresscooper.com and we will be happy to reply. So let me recap the last week's lecture and then Mahar will take you through today's lecture. So like I said, that since the last 4 weeks, we have been discussing this tax group guide. So just to give you a snapshot of how this guide looks like. So it has these 13 sections and there are different, sections of the guide. It's explaining different provisions. And this is a very detailed guide and it has clarified a lot of the concept of the tax group and a lot of questions which people had regarding this tax group. So we have already discussed what is a tax group, what is conditions to form a tax group, what to do after forming the tax group, what are the tax compliances, obligations, what happens when there's a change in member of the tax group, if there's addition or somebody leaves or the parent changes, what happens on the cessation of a tax group. Then we discussed how to calculate the taxable income of a tax group. And so we have discussed these 8 chapters up till now, and Mahar will take you through the 9th chapter in his lecture. So in our previous lecture also, we keep on reiterating that, when two or more taxable person, if they meet all the conditions of Section 40 of the corporate tax law, then they are able to form a tax group and to be treated as a single taxable person. So we keep on saying that this tax group is now, after the tax group is formed, approved by the FTA, it is treated as a single taxable person. So now when they are treated as a single taxable person, all the provisions of the corporate tax will now apply to them as a whole, as a tax group, and not to each individual entity. So previously, if we are looking at the different provisions on a single entities, now we will be looking at them as a whole. So let's discuss the corporate tax rate. So now we know that up to, if the taxable profit is up to 375,000, so the corporate tax rate of 0% is applicable. And anything above 375,000 is taxed at 9%. So where we were looking at this individually for the companies, now when the tax group is formed, we will be looking at the group level and not the entity level. So if, for example, there are 4 companies in a tax group, so company A, B, C, D, if they had like 100,000 taxable profit. So if they were not part of the tax group, we would have been, they would all have 0% on their income. But now because they're part of the tax group, we will look at all the taxable profits, which is 400,000. So now up to 375 would be taxed at 0%. And then the remaining 25,000 will be taxed at 9%. The same with the small business relief. Now, when we are looking at if the conditions of small business relief are being met and the consolidated revenue is less than 3 million, then the tax group can go for small business relief. Now, here also a consolidated revenue will be looked at. So, for example, if the revenue of the 4 members is 1 million each, so we will, if they were not part of the tax, we would have been looking at that and they would be applicable for the small business relief if all the other conditions are being met. But now we will have to consolidate it and this 4 million will be looked at, which means they will not be meeting the condition for the small business relief. This is also important because while we keep on, in our previous lectures, highlight all the advantages of forming a tax group, this is one of the disadvantages as well. So when a company is, deciding if a tax group needs to be formed or not, and they're looking at the administrative burden, they're looking at, the elimination of the intergroup transactions. They're looking at that, tax losses can be offset. So they should also look at this. So, whatever is applicable or beneficial for the group as a whole, then they should go for the decision. But these things should also be considered. Now for coming back to advantages again. So now when we are looking at the ownership requirement for qualifying group relief or transfer of tax losses of 75%, then for here, we will not be looking at it individually. We will look at on a tax group basis, on a aggregation of the ownership and interest of parents and each subsidiary in the member of the tax group. So this is one advantage that because of this, they might meet these conditions, which previously as single entities, they would not be meeting. Now, for participation exemptions, also there are two conditions. One is when we are determining the ownership interest of 5%, and also when we are assessing the acquisition cost of 4 million. So now both these conditions will also be looked at from a tax group level. So we will look at that if the tax group is holding this 5% or greater ownership interest in the shares or capital, and the combined ownership interest by all the members of the tax group will be considered here. Also, the ones that the ownership interest held by the external parties, which are part of the qualifying group, where this member of the tax group is also there. The same way is for the acquisition cost. Now, instead of looking at the individual acquisition cost, we will combine all the acquisition costs of all the members of the tax group and also of the qualifying group, where the member of the tax group is also a part of that qualifying group, and then look at if this condition is being met or not. So this is also one of the advantages of this tax group. Now, when a taxable person basically, has a qualifying group, there is an option that they can exclude the gain or losses which are associated with any transfer within the qualifying group. So this election is irrevocable, and it has to be submitted when we are filing the tax return for the tax period where this transfer takes place. So if the tax group, if there is a tax group where none of the members have made any decision right now, so if a tax group, as a whole makes this election, so it will apply to all the members of the tax group, and then it will keep on applying to all the members, even if they leave the tax group or even if the tax group is deregistered. Now, if a taxable person has not made an election, but they are forming a tax group or they're joining a tax group where already this election has been made, so it will be considered as that they have made this election as well. And the same that if a tax group, and the existing members are already there who have not made any election, but a new member is joining, a new subsidy is joining, which have already made this election before they have joined. So then this election will be applying to all of the group members. So like we said, the taxable person has this option to exclude gain or loss, but however, when we are looking at this gain or loss, so there is an exception. We need to see that if it is, if within the 2 years of the date of the transfer and the transferee are still a member of the qualifying group or not, or if there is any subsequent transfer of this asset or liability outside the qualifying group. So this needs to be seen. So now, for example, when we're looking at this ownership condition where, at least 75% ownership condition needs to be met, or, common ownership should be there of 75%. So this will be looked at a group as a whole group and not individually. So it might be possible that, there is a person who is part of or meeting this condition just because it's part of the tax group. But if, they were not part of the tax group anymore, they would not meet this condition. So it is possible that this qualifying group relief that is, given might need to be clawed back if that subsidy leaves the tax group. So now it won't be able to meet this condition at an individual level, or if the tax group ceases to exist within the 2 years of the transfer. Now, for application of limitation of tax loss carry forward, so tax loss can be carry forward and offset, but there's two conditions that needs to be met. That is the continuity of ownership condition and continuity of the business condition. So let's discuss the continuity of ownership condition. So here we say that the owner of the taxable person needs to hold at least 50% continuously, this 50% ownership throughout the period. This period is from when the tax loss was incurred to the tax period in which this offset is happening. So when we are saying that this continuous ownership, we are only referring to parent in this case. So the owners of the parent company needs to continuously hold this 50% ownership. So if this continuity of ownership condition is not being met, you can still offset the tax losses if the continuity of business condition is being met. And now when we're looking at the business condition, we need to look at the tax group as a whole. So now, for example, if a substantial part of the business of the tax group is operated by one subsidiary, and if that subsidiary leaves the tax group, it might be that now this business continuity condition is not being met. So for the continuity of business condition, we are looking at the whole group. For the continuity of the ownership condition, we are looking at the parent company. So a tax group, like an individual company, if it has revenue up to 3 million, can follow cash basis of accounting. Here we will look at the tax group as a whole. Same for accrual basis, we will be looking at the tax group as a whole. And if they are having a revenue of more than 3 million, then they need to apply the accrual basis. So if a tax group is following the accrual basis, they have an option to take into account the gain or losses on realization basis. The option is basically irrevocable and only can be reversed with the approval of FTA. Now, if you've chosen, in a tax group to follow, let's say, the accrual basis, and if you're leaving the tax group now, the member then still need to follow the same accounting basis that it was applied in the tax group. And when a new subsidy is joining a tax group and they have any unrealized gain or losses, then that would only be included in the taxable income of the group only upon the realization. So now we know that one of the deduction which is allowable is the expenditure which is incurred wholly and exclusively for the purpose of the taxable person business. So when we are looking at this, we need to look at the basis of the whole tax group. So it might be that the expenditure it will be deductible if it is incurred wholly and exclusively for one member or for several members of the tax group. It will meet this condition. So if any expenditure is incurred for the purpose of non-tax group members' business, for example, foreign parent that is not a resident person, then that is not deductible. Now, the transitional rules are there in the corporate tax law. They aim to limit the taxable gain to the gain which has arisen after the start of the first tax period. So in relation to the categories of assets that are owned by the taxable person prior to the first tax period. So it's trying to limit this gain. So in the case the tax group is formed in the first tax period following the introduction of corporate tax law. So whichever is applicable from them, for example, January to December, so it would be 2024. So the opening balance sheet of the tax group will be the consolidated balance sheet of each member of the tax group on the last day of the financial year that ends immediately before the beginning of the tax group's first tax period. And then any election that we are making, in terms of this transitional rule, they also need to be made by the group, and they will continue to apply to all members like we discussed with the other elections, that once the elections are made, it will keep applying on the tax group members, even if they leave the tax group or even if the tax group ceases to exist. Now, in terms of treatment of subsidies which are not 100% owned, so now any income which is realized by a subsidy, it needs to be included in full in the taxable income. It doesn't matter if they are 100% owned or not. In that case, also they need to be taken. But at the tax group level, the ownership in the subsidy that is held by the person who are not members of the tax group will be recorded as the tax group's capital. And any profit distribution from the subsidies to other member of the tax group, the parent company and other subsidies, they will be eliminated in the computation of this taxable income of the whole tax. So now I think this was a recap of the previous section 8 of the tax group guide, and I will hand it over to Mahar, and he will take you through.
Hello, everyone. Thank you, Faiza, and everyone. Thank you very much for joining us once again. So we are discussing today fairly assessing taxable income of the group members. The question is why we are required to assess the taxable income of the group member. The important thing is there are certain conditions given in the law, basically specific requirement of the law that we need to assess the taxable income of the individual group members as well. So while assessing the taxable income of the group member, there are some sort of rules, principles that we need to follow, but special rules has been given for the intra-company, intra-group loan as well. As we know that a group is liable to consolidate the financial statement, that consolidation will stay itself. But this, whatever we are discussing today, individual members' taxable income, this is required for certain calculations, basically. That ultimately it will have impact on the group profits. So there are 4 conditions basically. In these 4 conditions, we are required to assess the taxable income of the individual group members. The first is unutilized pre-grouping tax losses. If there is a one group in the group, one member has ungrouping pre-grouping tax losses, we know this that the member can offset maximum up to 75% of the taxable income of the group. Then the law says basically the member must have the taxable income. So important thing is if the member wanted to adjust the pre-grouping tax losses, we need to calculate the taxable income of the individual member. We need to ascertain the 75% of the group taxable income. This 75% of the group taxable income, we will assess this, is fine. But 75%, but if the member can have adequate taxable income, suppose this member has pre-grouping tax losses of 100, and we need to assess this income, we need to compare with this 100. If the available member adequate income during the current period is less than 100, then might be this 100, this is for sure, this 100 will not be fully adjusted. If this tax income is more than 100, then this 100 will be adjusted, but this 100 should not be more than 75% of the group taxable income. So this is the first requirement where we need to assess the adequate taxable income of the individual member as well, because we wanted to adjust the unutilized pre-group tax losses. This is the first requirement. At the end, the result will be consolidated, but we need to assess, can we claim the pre-grouping tax losses or not? Just to assess this, we need to assess the adequate taxable income of the individual member as well. Then income from the foreign tax credit earned by member of a tax group. The multiple member in the, assuming in the tax group, or two members in the tax group, one member has foreign tax credit. If the one member has foreign tax credit, then the law says this credit cannot exceed the corporate tax due on the member's relevant income. This credit cannot exceed the corporate tax due on the member relevant income. Means we need to assess the relevant income of the individual member. We need to assess the relevant income of the individual member. Once we're assessing the relevant income of the individual member, then we need to calculate the tax due on the relevant income of the individual member. Whatever is tax due on the relevant income of the individual member as per the UAE law, maximum up to that amount foreign tax credit is available. Means we need to calculate the individual members taxable income as well to assess how much foreign tax credit the members can avail. As we know, this foreign tax credit cannot be carried forward, cannot be carried back, but we need to assess the tax due as per the UAE law on the individual members taxable income to assess can we claim the foreign tax credit or not. If the individual member is making losses, individual member has foreign tax credit, individual member cannot claim the foreign tax credit. If the individual member has, assuming income is whatever the income, 1 million up to 300 from this is exempt, remaining is the income, the up to this income will be subject to tax at 9%. This 9% will be the tax due in the UAE. This 9% will be compared with the foreign tax credit. Maximum up to this amount we can claim foreign tax credit, otherwise beyond this amount we cannot claim foreign tax credit. The objective is basically we need to assess the taxable income of the individual member as well to claim the foreign tax credit. Third, Article 22G of the law says basically any incentive or special reliefs of a qualifying business activity as specified in the decision issued by the cabinet at the suggestion of the minister. This is basically exemption, the incentive reliefs. This is the requirement of Article 22G. Any incentive or relief for the qualifying business activity might be, now there is a possibility these incentives, these reliefs depends upon the taxable income of the individual taxable person. So if these incentive, these reliefs depends upon the taxable income of the individual tax member, then we need to assess the we need to calculate the taxable income of the individual tax member as well. Fourth condition, unutilized carry forward pre-grouping net interest expenditure. Initially we'll discuss pre-grouping tax losses. Now there is a pre-grouping net interest expenditures. One member is joining a group. Once a member is joining a group, this member has pre-grouping interest expenditures. We know that this interest expenditure can be adjusted maximum 30% of the EBITDA, remaining can be carried forward for further period of 10 years. Now, once this member has joined this group, now this member is carrying pre-grouping net interest expenditure. The law says this pre-grouping net interest expenditure can be adjusted against the taxable income of the group. The important thing is they're asking two conditions. First, this interest pre-grouping net interest expenditure cannot be adjusted more than 30% of the group's EBITDA. or 12 million, whichever is higher. This 12 million is applicable on overall group. This 30% is applicable on overall group. So we need to calculate the group EBITDA. We need to say the 30%. We need to look into this. Higher of this, it can be claimed 100%. But at the same time, law says whatever is being claimed, this should not be member has sufficient taxable income. The member has sufficient taxable income means we need to calculate the taxable income of the individual member here as well. So these are the four conditions where we need to calculate the taxable income of the individual tax member. Group consolidation will be there, group taxation will be there, group consolidated taxable income will be there, group will be liable to pay the tax. It will be the parent company responsibility to make sure all these things are happening. But at the same time, just to make the calculations, how much benefits can we claim, how much interest we can claim for this pre-group and tax losses, how much loss we can claim for the pre-group and tax losses, how much interest we can claim for the pre-group and net interest expenditures, or can we adjust the foreign tax credit, or in certain specific incentives given by the government under the Article 22G. So these are the full scenarios which required that we need to calculate the taxable income of the individual tax member as well. Once we're calculating the taxable income of the individual tax member, there are some sort of principles. Just look into this. This is the group. These are the members in the group. Now, what the law says basically, one member in the group, there is the intra-group transactions. There is one member A, this is a company A, this is company B, they are part of the one group, there is a transaction in between A and B. If these transactions are being eliminated, law says, then we need to assess the fair market value. Fair market value assessment is necessary if there is a transaction between the group members and these transactions are being eliminated. We have already discussed the elimination principles. And if these transactions are being eliminated, then we need to assess the fair market value of the transaction. If these transactions are not being eliminated between the group member, then the law says we need to take the value given in the consolidated financial statement. So this is the first principle. If the transactions are being eliminated, we need to consider the fair market value. If the transactions are not being eliminated, then the law says we should take the value given in the consolidated financial statement. Now, this is elimination principle. This is basically attribution principle. Now the fair market value principle given in the law. What are the fair market value principles? We know this, what is fair market value? There is a possibility that the transaction between the group member take the same transaction between A and B. This transaction, there is a possibility this is above the market value, below the market value, at par or at zero. This below the market value, this zero is basically some sort, you can say this is below the market value. There are four possibilities: above the market value, below the market value, at par or at zero. If this is already at par, we are not liable to do anything. This is already at the fair market value. If the transaction is above the market value, below the market value, or at zero without any consideration, then the law says, first of all, we need to assess the correct market value. What is the correct market value? We need to assess the correct market value, fair market value of the transaction. Once we have assessed the fair market value of the transaction, then we need to eliminate the transaction. While eliminating, law says transfer of assets and liabilities within the group, it will always be reflected at zero. This is the exception, basically. It has been given in the guide. Transfer of assets and liabilities will be at zero. I think it is given in the Article 26 of the law. This will be zero. But other than this transfer, other than all intra-group transactions, we need to assess the fair market value. We need to eliminate an elimination principle we know. Then if this group member, assuming this B has incurred any cost. If the B has incurred any cost for A, then the law says whatever B has incurred, B needs to charge A at the market value. This is also fair market value principle. And while assessing the fair market value, we have discussed what we have discussed. Basically, we discussed transaction value, attribution principle. Transactions are being eliminated. We need to assess the arm length. We need to follow the arm length principle. If transactions are not being eliminated, then we need to take the value reflecting in the consolidated financial statement. What is the arm length standard? We need to assess the fair market value. There is a possibility the price are at below, above, at zero, or without any consideration. Then we need to assess what is the fair market value. And we know what are different benchmarking techniques. How can we assess the fair market value? The different 5 methods to assess the fair market value. Now I would discuss one member has incurred transaction on behalf of other any other member, they need to charge at the market value. Asset and liability should be reported at the zero as given in the law, as given in the financial statement. We should not change this. Basically, it will be keep reflecting asset and liability tax group can be treated as taking place at no gain, no loss, as given in the Article 26 of the law. Member of a tax group. Now the arm length application. Now we have discussed, first of all, basically we'll discuss what are the areas where the specific conditions where we need to assess the taxable income of the individual tax member. This is the first thing. Then we discussed that how can we attribute the income? Attribution principle. Then we discuss the fair market value principle. Now we are learning application of the fair market value. Application of the fair market value is very straightforward and simple. Okay, just let me keep it here. This is the group A, company B. In the group, there is a possibility that they have a transaction in between the group member. There is a possibility the transaction is out of the group. Transaction is out of the group. Party C is third party. If the transaction is out of the group, this would already be at the fair market value. This will be already attributed to the respective member of the tax group. We are not liable to do anything. Now, if the transaction is between the two members of the same group, if the transaction is between the two members of the same group, the principle is basically we need to assess if A has income, B has corresponding expenses or not. Or if the B has income, A has corresponding expenses or not. This is the key principle. So if the A has income, B has corresponding expenditures or not. If the B has income, A has corresponding expenditures or not. If A has income and B has no corresponding expenditure, it will not be considered. It has been given in the guide. If the A has income, B has corresponding expenditure, this will be adjusted. A income will be reversed, B expense will be reversed. If the B has income, B's income will be reversed, A's expense will be reversed. So while reversing this, the important thing is we should keep in mind that the total income of the individual members should not be exceeding more than the total income of the group. This is the key principle. So how can we apply the arm length principle? This is the key principle we discuss in our illustration as well. The special rules has been given. The special rules has been given for the special rules has been given for the intra-group loans. This is the group. Company A, company B, there is a possibility company A has given a loan of 1 million to company B. Once A has given a loan of B to B, if there is a loan out of the group, A has given a loan to C, anywhere this is out of the group, third party, it will always be at the market value. It will not have any impact on A. A's income, it will be fine. The problem is in between A and B, which are the same group members. Now A has given a loan to B. If the A has given a loan to B, assuming 1 million, then the law says general interest deduction limitation rules will be applicable to the individual member, to the group as well. So basically interest bearing loan, if the A has given a loan to another member of the same group, so general interest deduction limitation rules and specific interest deduction limitation rule will be considered. These limitations are applicable on the borrower. If A has given a loan to B, B is a borrower, A is a lender. If loan has been given from A to B, B cannot claim 30% of EBITDA or 12 million, whichever is higher. This is the interest limitation rules. So if B is not claiming any portion of the interest, if B is not claiming any portion of the interest, assuming A has charged interest to B of 100 Out of this, B can claim only 70. 30 had not been claimed by B. The law says the 30 which has not been claimed by B, B will not claim 30. A will reverse the corresponding expenditure, the corresponding interest which has not been claimed by B, because A has already booked income. Whenever A is charging to B, A has booked an income. Once the A has booked an income, A has booked an income of 100, B will claim as 100 principal, apparently looks like, but B the limitation. Once the limitation will apply, B cannot claim more than 70. So 30 A needs to reverse and B should not claim. So interest limitation, deduction limitation rules will be applicable. The interest limitation from a borrower, if the borrower has restricted interest in their books due to a member of the tax group, lender will also reverse the corresponding interest income that was just discussed, A and B. 30, read this. If the borrower has restricted interest in their books due to a loan from a member of a tax group A to B, the lender will also reverse the corresponding interest income in their record. 30 will be reversed by the lender as well. Interest deduction on loan from third party will only be limitation. It will not have any impact, but we need to consider the group restriction as well. If the group is not claiming certain portion, then we need to restrict. The same restriction will be applicable on the individual member as well. Now there are different possibilities. The possibility is A has given a loan to B. Both are member of the same group. A has given a loan to B. Now this loan is of 1 million. This 1 million loan, A, various possibilities. A can impair the loan. Impair the loan. A can impair the interest income. Or A can waive the loan. There are three possibilities. Or there will be reversal of interest income as well. You can say four possibilities. The first possibility is impairment of the loan. Second possibility is impairment of the interest. Third possibility is reversal of the impairment of the interest. Fourth possibility is waive off of the loan. These four different things, different situations have been discussed in this guide. The first is impairment of the loan receivable. Law says once A is impairing the loan, it will not have any impact on B. So we have already discussed adjustment will be only there when there will be a corresponding income or corresponding expenditures. If A is impairing the loan, it will not have an impact on the B. Once it will not have an impact on the B, it will not require any adjustment. The same it has been given here. The impairment usually doesn't result in the corresponding income of the borrower. In this case, the deduction should not be considered to calculate the taxable income of the individual group member. Impairment of interest. The first is impairment of the loan. Second is impairment of the interest. When impairment of the interest, it will reverse there is a possibility, it will reverse the expenses of the B as well. So if the expenses are being reversed, here income is being reversed, here expenses are being reversed, adjustment is required. Here expenses are being reversed, here income is not being reversed, it will not be required any adjustment. This is a simple rule. So you can go through this. It is considered to happen after the initial. The important thing is whenever the lender is impairing the interest on loan, the law says first they need to recognize the income, then they need to reverse it. It will have a nil impact on their financials. So it is considered to happen after the initial recognition of interest income. Yes, the lender acknowledges both the interest income and the impairment of the interest receivable, which will have a zero impact on their financials, but presentation is necessary. As a result, interest expenditure recognized by the borrower on a standalone basis. There is a possibility borrower is recognizing the interest on standalone basis. The expenditure will reduce the attribution of taxable income to the borrower. Basically, if the corresponding interest has been booked and when the impairment of interest, the borrower will reverse the interest and it will have an impact on the taxable income of the borrower. And the corresponding income would increase the attribution of taxable income to the lender. Would increase the attribution of taxable income to the lender. Basically, this is, you can say on overall basis, as I discussed. If the lender is reversing, corresponding impact is there, impact will be adjustment is required. If the lender is reversing, corresponding impact is not there, then we're not liable to do anything. The last case is the reversing a prior loan impairment is the loan. So the third one, if the loan which has been given from the lender to the borrower A to B, If the A is reversing now, once the A impaired the loan, it was not required any adjustment because the corresponding impact was not there. Now A is reversing the impairment. Again, there will not be any corresponding impact on B, so it will not be required any adjustment. So it will not be borrower record unless the member of tax acknowledge a deductible tax losses. Yeah, one situation is there. Sorry for this. One situation it will an impact. They said if there is a pre-grouping, any transaction between two members of the tax group for which the one member of the tax group has already claimed the expenses which has reduced their taxable profit, that impact now if they're booking any income, they are claiming the expenses again. Being a part of the tax group, they will not be able to claim the expenses again unless and until whatever the losses they have already claimed before entering into the tax group, it has been reversed thoroughly. So one exception is there. So if this exception is not applicable, the reversal of such impairment will not be taken into consideration that we have already discussed. Fourth is waiver of a loan. Once the loan is being waived off, A has given a loan to B, now A is waiving off the loan. Once this is waiving off the loan, it will impact on the obligation of the B's taxable profit will be reduced. Now A usually results in income of borrower due to the cancellation of the obligation. Yes, the income will be evaluated in lender record arm's length basis. Yes, up to the extent of any loss reported by the lender. In the basically the one restriction is there, whatever the lender record, whatever the loss lender is booking, the corresponding impact will go to the B as well. If the lender has not reported any loss, the income will not be considered. They will not be, if whatever the loss to the lender, the same impact, the same amount will be reversed in the B books. Otherwise, it will not have any adjustment. So this is lecture. We can go through the example very quickly. Okay, company and B are in the tax group as of 1st Jan 2025. Company and B are both use the Gregorian calendar year as their tax period. Company and company B has unutilized pre-grouping losses. One unutilized pre-grouping losses we have already discussed. This is one of the condition where we need to assess the taxable income of the individual tax member as well to assess how much of the pre-grouping losses can be considered once the member has become a part of the tax group. And hence the tax group is required to determine taxable income attributable to the company and company B on a stand-alone basis. Yes, this is the requirement due to which they need to assess their taxable income. Company holds a loan receivable 1 million with B and borrower with interest rate of 5%. The situation is same A to B. A has given a loan to B and interest rate is 5% and the value is 1 million. And in 2026, A impairs the loan receivable from B to 0. Impair the loan receivable. We have already discussed. Once the A is impairing the loan receivable, A is that for impairment of loan receivable, impairment of interest, reversal of the impairment of interest, waiver of the loan. Once A is impairing the loan receivable, it will not have any corresponding impact on B, so it will not be required any adjustment. We'll look into this. So A impaired the loan receivable from B to 0 in 2026. Company B continues to recognize the liability for the full nominal value of 1 million. A has impaired, B is recognizing at the same value of 1 million. In 2027, Company A releases the loan. Company A releases waiver of the loan, creating 1 million of income for B. In 2027, A has waived off the loan. Once the A has waived off the loan, it will have a reduction in the obligation of B, which is assumed to be consistent with the arm length principle. So this is an example. Now we need to apply whatever we discussed earlier. Company A was a separate taxable person. B was a separate taxable person. Both were part of the tax group. Once both were part of the tax group, there was a pre-grouping losses. We need to assess the individual member taxable income. Loan is being impaired by A to B. Loan receivable is being impaired. It will not have any corresponding impact on B, so it will not be required any adjustment. You can go through the wording. A is a separate taxable person. Yes, it will recognize a deduction against taxable income 1 million. B is a separate taxable person. Okay. B is impairing the loan. Group calculation will be required. This is very important. In the tax period 2026, the impairment loss is not taken into account. Why? The attribution of taxable income A to B, the reason is because there is no corresponding impact. A is impairing the loan, it will not have an impact on B, so adjustment is not required. This is a second. Now we are discussing this. Company releases the loan, waiver of the loan. Once there is a waiver of the loan, keep in mind the law said there should be, when the law is being there, corresponding impact should be there. Now, once this loan is being waived off, A has already impaired the loan. It was 1 million. They have already impaired less 1 million. Cost is 0. Here cost base is 0. Now A has impaired in 2026, but they have given waiver in 2027. So in 2027, their cost base was 0. Once the cost base is 0, do you think it will be required any adjustment? No, because the corresponding impact is not there. So in 2027, it does not trigger any deduction from the taxable income of A, as the cost base of the loan receivable was already reduced to 0. Cost base was already reduced to 0. Company B would recognize the taxable income of 1 million as a result of the release. It will have a standalone taxable income, standalone for B. Thus, on standalone basis, there is no deduction corresponding to the income claimed by the B. There is no impact corresponding impact. Therefore, in 2027, release is not taken into account. Release is not taken into account for the attribution of taxable income to A and B because the corresponding impact was not there, because this loan was impaired in 2026. This loan was waived off in 2027. In 2027, cost base was 0. There was a no corresponding impact. So this adjustment is not required in the income in the books of A and B. Thank you very much. This is over from my side. This is over from our side. If you have any question, you are most welcome. You can approach us. We are always available. You can approach me, Faiza, the other team members. We are already always ready to listen, ready to understand, ready to deliver. If you have any question, you are most welcome. No question is there? Okay, thank you very much. Thank you and have a lovely day. Thank you, Faiza. Take care. Thank you.
Thank you, everyone.
Thank you.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.